Welcome to our channel. Let's unlock your knowledge with Tally Unlock.
In this section, you will learn basics of accounting that you need to know in order to learn Tally. So in this video, I'm going to show you how to record journal entry and how to decide what account to debit and what account to credit. And in case if you are already acquainted with the knowledge of recording journal entries and basics of accounting, then you can skip this section. Accounting is a vast subject, and I will cover some basics of accounting that will be useful in order to work with Tally. So if you are new to accounting and if you don't have any idea about accounting, then please don't skip this section, and I will cover concepts in an easy to understand manner. Why do we need accounting? Accounting is referred as language of business, and it's an organized way to record day-to-day business activities like purchase, sales, and expenses of a business. And it is a formal way to record business activities in efficient way that complies with accounting standards. And by accounting standards, what I mean is that there are certain set of rules that each business needs to follow at the time of recording their activities like purchase, sales, expenses, and so on. So by following those standards, we can communicate our financial information with other businesses and with other stakeholders. So by stakeholders, we mean an investor who is investing in your business, or a supplier or other business. So in large organization, when a supplier decides to conduct its business with you on credit terms, then it would like to know your business performance. So that supplier would like to read your profit and loss statement and balance sheet report in order to know how well your business is performing. So in that case, you will need accounting to prepare all those reports, and it is required by the governing authorities like tax authorities to maintain accounts using accounting standards. And accounting business accounts helps you to understand whether the business is earning profits or running into loss, and how much expenses and incomes have been generated in various departments. So all those things would be covered under accounting. So it helps you quantify your business position in terms of profitability, resource spending, etc. And maintaining informal accounts are not meant for business, because it becomes unmanageable when your business grows to maintain accounts informally, and it doesn't provide any accurate information. Suppose if you are trying to find dues of a supplier, then you need to go through the ordeal of searching and remembering rough calculations. But with properly maintained accounts, you maintain account of each supplier and maintain his records of payments and dues. And informal accounts are inefficient way to conduct business, and it doesn't comply with accounting standards. Therefore it won't accepted by the tax authorities. So it's no point in maintaining accounts informally. So organizations that follows accounting standards maintain accounts of each financial dealing. They maintain account of sales, purchases. They maintain accounts of suppliers, buyers, and expenses that incurs, and cash transactions like cash payments and cash receipts. And in accounting, when you maintain account of each of these types, then you name them using the following convention. So each account is suffixed with the letter A/C. So for purchase, you write the name of its account as purchase account. For sales, you write it as sales account, and so on. And under each account, you maintain its respective records. So for example, under purchase account, I would maintain record of all the purchases that I made for a given period, and I would also record all the purchase returns which I have made during that period. Similarly, under sales account, I would maintain record of all the sales which I have made during a certain period. And under cash account, I would maintain all the record of cash inflow and cash outflow in my business. So similarly, there could be many accounts depending upon the activities. So suppose if we are paying rent, then we maintain its account under the account heading rent account, where we record all the rent payments. So this is how the accounts is done. Let me show you how a cash account would look like. So this is the format which we use in accounts to record cash inflow and cash outflow. So on the left hand side, I have recorded all those activities by which my cash has increased, and on the right hand side I recorded all those entries by which my cash got decreased. So there was an increase in cash because I made sales worth 20,000 and I received rent worth 10,000, and the total of cash inflow is rupees 30,000. And similarly on the right hand side, I made few expenses towards purchase, electricity bill, I paid salary, and the expense total was rupees 21,500. And I added the difference between cash inflow and cash outflow on the right hand side of the account. One thing that you must remember is you need to add the difference on the side where the total is low. So since expense total was lower than that of incomes, that is why I added the difference on the expense side, so that the total on both sides should be 30,000. So this is an accounting convention where you need to balance both the expense side and the income side. So that is why I added the difference on the side where the total was low. And this is the cash account report for the month of January. So in the following month, that is the month of February, you need to pass the remaining balance as the opening balance. So on 1st of February, I can see that I am left with cash balance of rupees 8,500. And in accounting world, this format is referred as ledger. And by convention, the left side of the ledger is called debit side of the ledger, and the right side of the ledger is called credit side of the ledger. Now there are certain things that you must need to know about debits and credits. So these are some basic information, and if you remember these rules, then it will make it clear as to how to use debits and credits. And of course, these are not formal rules about debits and credits, which you are going to learn in few moments. But this will change your perception as to how you see debits and credits. So there is a common perception that debits is always a good thing and credit is like a negative thing, but it is not like that. Debits and credits are simply additions or subtraction from an account, and debit doesn't always mean an increase and credit doesn't always mean a decrease. So there are rules as to what accounts increases with a debit and decreases with a credit, and there are rules as to what accounts decreases with a debit and increases with a credit. And you will understand why we debited all incomes and credited all cash expenses, because there are some rules which I am going to explain. And like cash account, there are other accounts maintained in the business. So what are all those accounts? So let's find out. And once we know what those various accounts are, then we will discuss as to how a debit and a credit would affect that account. So let's first find out what are the common accounts that are usually maintained in the business. So these are the accounts which are usually maintained by most of the businesses. So the account, capital account, maintains records of money invested in the business and money withdrawn from the business. The cash account, which we just saw earlier, maintains records of cash receipts and cash payments of the business. The account purchase account maintains records of purchases with its dates and its total and any purchase returns which have been made for a given period. Similarly, a sales account maintains records of sales transactions and any sales returns for a given period. Accounts receivable accounts maintain records of dues that is owed to you by a customer or a borrower. So under these accounts, we maintain records of those customers to who we have made credit sales. And under accounts payable accounts, we maintain records of dues that we owe to others, like a supplier, or to a lender like a bank or any lending organization. And under expense accounts, we maintain records of expenses. So there could be various operational expenses for an organization. So an organization may be paying salaries, or there could be a depreciation on assets, which is an expense to the business, or we incur any loss. So loss are reported under expenses, and we maintain account of each expense type. For example, we record all salaries under a account called salary account. We record all depreciation expense under an account called depreciation account. And business may be getting income from various sources apart from sales. So a business may receive rent, or it may have received any discount from a supplier, and there could be an income from sale of old items, and all such accounts are recorded in its respective accounts. So all rent receipts are recorded under an account called rent account. All incomes from sale of old items are recorded under its following head called sale of scrap account, etc. So these are some commonly maintained accounts, but there could be other accounts which could be maintained by the business. And covering all those accounts is out of the scope of this course, because this course is primarily for learning Tally, and therefore I included most of the common accounts which are usually maintained, so that it would be easy for you to get a start off with the accounting journey. Now let's continue with the session. So these accounts are categorized under one of the following accounts on the right hand side. So the accounts on the left hand side could fall under one of the categories which are on the right hand side. So let me explain each of these categories: assets, liabilities, capital, expenses, and revenues. So assets. An asset is anything which is of value to the company. So cash is a primary asset, because obviously cash holds value and it is valuable to a company. So similarly, there could be any other items which adds to the value of the company. So the properties like building and office space are asset of an organization, and any belongings like tools, machinery, furniture are assets to the business. And accounts receivable accounts, which are dues from the customer, are asset to the business, because we know that in future we are going to receive a particular sum of money. So that value becomes asset to the organization. And similarly, there could be other things which are of value to the organization, which qualifies to be an asset for an organization. Liabilities. So liabilities are company's obligation to pay back due amounts to supplier or to a bank. So when you borrow money from a bank, so you are liable to pay it back. Those amounts are part of the liability of your business. And the accounts payable accounts, which are dues that we owe to the supplier, are also liability of the business. And any sales proceeds which is to be carried after receiving advance payment from a buyer are also liability of your company. And capital, I already explained what capital account is. Expenses, expense accounts are related to expenses and loss that incurs to a business. So the following accounts falls under the expense category. And also remember that purchase is also an operational expense to a business. Therefore, purchase is an expense type account. Revenue accounts. So all income accounts are categorized under revenue. So any discount received account, sale of an item account, commission received, and particularly sales. Since sales generates revenues, it is categorized under revenues. So these are the categories of accounts. So to summarize accounts and its respective categories, here is a summary. So all cash accounts are assets type. Any due that you are eligible to receive from a debtor, that is the customer, are assets to your organization. Any due that you owe to others are your liabilities. Any capital that you invest falls under capital category, and all expenses accounts including purchase accounts falls under the category expenses, and all income accounts including sales accounts falls under revenues. And here is a snapshot of categories and the accounts that falls under the relevant category. I want you to pause the video and have a look at the screen. Alright, so now we will talk about transaction. So what is a transaction? It is a business activity like purchase, sale, payment, or receipt of cash. So any such business activity is a transaction. For example, purchase goods worth 5,000 is a transaction, and these transactions are recorded in a daily book called journal. And when you recorded transactions, there are at least two accounts which are involved in the transaction. So one account would be debited and other would be credited. So for example, for this transactions purchase goods worth 5,000, the two accounts would be a purchase account and a cash account, because these are the accounts that are affected in the transaction. So we record a purchase and we also record a cash expense. Likewise, depending upon the transactions, there would be minimum two accounts involved in a transaction. And we record the transaction in a journal book in the following manner. We debit the purchase account and specify the amount in the debit column and credit the cash account for the same amount. So why did I debit at purchase account and credit at cash account? So remember this chart of categories and the accounts. So the accounts that falls under assets and expenses increases with a debit and decreases with a credit, and the accounts that falls under liability, capital, and revenue increases with a credit and decreases with a debit. So considering these rules, we debited the purchase account because we know that expense accounts increases with a debit and asset accounts decreases with a credit. There is an increase in purchase, and purchases are expense accounts. We denote increase in expense with a debit, and there is a reduction in cash because we are paying cash towards the purchase, and an asset account like cash account decreases with a credit, so that is why we credited the cash account. Alright, now let me show you some common transactions that takes place in a business, and I'll explain its journal entry. So in this transaction there is a person called Ajay who invested rupees 1 lakh in a business. So the accounts involved in this transaction are cash account and the capital account. So before passing a journal entry, you need to identify the accounts that are involved in the transaction. Now let's go back to the debit and credit rules. So in this transaction there is an increase in cash to the business, okay, and we know that cash account increases with a debit, and on the other hand there is an increase in capital, and to denote increase in capital we credit the capital account, and accordingly we pass the journal entry as follows. We debited the cash account and credited the capital account. Although the cash belongs to the owner, we still say that there is an increase in cash to the business, because from the business perspective we can say that the business now has amount of rupees 1 lakh with it which it can utilize. So there is an increase in cash for the business, and in order to denote who invested the money and increase in capital, we credit the capital account by the rule that credit increases capital. So that is why we credited the capital account. Now let's proceed to the next entry. So it is a purchase entry from a dealer called Mahavir Electricals. So the accounts involved in these transactions are purchase account and the Mahavir Electricals account, which is a accounts payable type account. Since we are purchasing goods on credit, so our liability to pay to Mahavir Electricals has increased, and accounts payable accounts are categorized under liabilities. And now let's find out which account to debit and which to credit. So we know that purchase accounts increases with a debit, and on the other hand liabilities increases with a credit, and accordingly we pass the journal entry as follows. We debited the purchase account and credited the supplier's account. Alright, now let's move to the next transaction. So it is a credit sales transaction to a buyer called Super Stationery. So in this transaction the accounts involved are the sales account and the buyer's account, which is an accounts receivable account. And accounts receivables like dues from customer are asset to the business, and we know that assets increases with a debit and revenues like sales increases with a credit, and accordingly we pass the journal entry as follows. We debited the buyer's account and credited the sales account. So when we debit the accounts receivable account, we debit in the name of the buyer so that the due amount can be associated with the buyer. Now let's proceed towards the next transaction. In this transaction we are making a payment towards rent, and the accounts involved in this transaction are the cash account and the expense account, which is the rent account. And we know that expenses like rent increases with a debit, and to denote decrease in cash we will decrease the cash account by a credit, and accordingly we pass the journal entry as follows. We debited the expense account and credited the cash account. Now let's continue with the next transaction. In this transaction we are paying cash to the supplier for a credit purchase, and the accounts involved in these transactions are the cash account and the supplier's account. There is a decrease in cash, and there is also a decrease in liability, and by rule decrease in cash is denoted with credit and decrease in liability is denoted with a debit, and accordingly we pass the journal entry as follows. We debited the supplier's account and credited the cash account. So our liability towards this supplier has been reduced, and we reduce liability with a debit. Now let's proceed with the next transaction. So we received a sum of 4,000 rupees from a buyer, and the accounts involved in this transaction are the cash account and the buyer's account. So naturally there is an increase in cash because we are going to receive cash from a buyer, but we need to reduce our accounts receivable account which are dues from the customer, and we reduce the due amounts from the customer account to the extent of the amount that we receive. And we know that to denote increase in cash, we debit the cash account and we reduce accounts receivable account by means of a credit, and accordingly we pass the journal entry as follows. We debited the cash account and credited the buyer's account. So that's all about the journal entries and the rules related to debit and credit. And this session ends here, and I want you to go through the summary of this section. I want you to pause the video and have a look at your screen.
Thanks for watching and subscribe my channel.